Hi, Adam Odell here. In this video, I want to debunk a big myth about options, that they're complicated. Why do most average Joes assume that options trading is too complicated? Because when most professionals talk about options, we make it sound complicated. You hear things like strangles, straddles, and iron condors, vertical spreads, calendar spreads, and synthetic longs. We refer to an options delta, gamma, and vega. And all these things sound like alien psychobabble to the average investor, right? Well, again, I think it's pretty clear that most professionals would rather have options tradings to themselves. So they talk about how risky options are and how complicated options are, as if they're doing you a favor and persuading you not to bother with options. But in reality, options trading can be as simple as buying low today and selling high a couple months down the road. Basically, no more complicated than buying a stock with the same aim of selling it at a higher price later on. That's how I use options, and that's the simple, easy to implement style of options trading I've helped thousands of Cycle 9 subscribers master over the years. Now let's go over some basics. There are only two types of option contracts: call options and put options. Now, the textbook definition of a call option is something like this. A call option is a contract which gives the buyer the right, but not the obligation, to buy 100 shares of the underlying stock at a predetermined price, the strike price, anytime before the contract's expiration date. Okay, so that sounds a bit complicated, right? But before we go any further, I think it'll be helpful for you to know that in my Cycle 9 alert service, we have never converted an options position into a stock position. We've never exercised our right to buy 100 shares of the underlying stock, even though we had the right to, and in many cases we could have done so for a pretty handsome profit. So for that reason alone, it's not really necessary that you know the textbook definition of a call option. Instead, if you're following my Cycle 9 alert service, here's the simplest definition I think you need to know. A call option is a bullish bet. When you think a stock or ETF is poised to move higher in price, we buy a call option, thus making a bullish bet on the stock or ETF. It's really as simple as that. Now, a put option, it works the opposite. The simplest definition you need to know is a put option is a bearish bet. So when we think a stock or ETF is poised to drop lower in price, we buy a put option, therefore making a bearish bet on the stock or ETF. If you can just commit those two basic definitions to memory, you'll have like 80% of what you need to know to follow my simple options recommendations. So remember, a call option is a bullish bet. A put option is a bearish bet. If I think Amazon is going to zero, I should buy a put option. If I think a gold ETF is about to rocket higher, I should buy a call option. If I'm considering buying 100 shares of Apple stock because I think it's going to go higher, but I'm interested in learning how I can do that with less capital, less risk, and unlimited profit potential, then I should buy a call option. If I'm considering shorting 100 shares of Tesla stock because I think the company is a fraud, but my broker tells me that shorting a stock is complicated and risky, and so I'm interested in learning how I can make a bearish bet against Tesla with less capital, less risk, and unlimited profit potential, then I should buy a put option. Again, call options are bullish and put options are bearish. And that's really all you need to know about the two types of option contracts that I recommend trading. So now let me show you two examples taken from actual option recommendations that I've shared with my Cycle 9 subscribers. We'll cover one bullish play. What do you think we bought to make that bullish play? And then we'll cover one bearish play. Okay, so on April 17, 2018, my Cycle 9 alert system alerted me to a bullish opportunity in the Spider Biotech ETF, ticker symbol XBI. The ETF was trading for around $90 at the time, meaning that it would have cost a hefty $9,000 just to purchase 100 shares. But we didn't do that. Instead, we made our bullish bet by buying call options. The specific call option I recommended at the time was selling for $630 per contract, essentially giving us a 93% discount on the bullish position. Now, that call option contract had a set expiration date of September 21, 2018. meaning we knew we needed to be out of the position before the end of September, about 5 months down the road. And we'll cover this in more detail later, but the fact that option contracts have expiration dates is really no worry to us. We never intend to hold the position for more than 2 to 3 months. So we never really end up needing the full amount of time until an option's expiration. And on this one, we got the bullish move we were positioning for after just 2 months. Shares of XBI climbed from around $90 in mid-April to $99 by mid-June for a roughly 10% gain. And during that time, the value of the call option I recommended had grown by 45%. On June 19, just 2 months after our entry, I told subscribers to sell their call options for $915 apiece, locking in that market-beating 45% profit. So in summary, we identified a bullish opportunity, we bought call options for a low price, and then we sold the options 2 months later for a higher price. Pretty simple, right? Okay, so now let's look at one more example. Interestingly enough, just weeks after I recommended that bullish position on the biotech sector, my Cycle 9 alert system alerted me to a bearish opportunity in the SPDR Utilities Sector ETF, ticker symbol XLU. There was a very good chance that shares of XLU would drop sharply lower in the months ahead. The ETF was trading for around $51 a share at the time, and had you decided to short the ETF, you would have needed your broker's approval and about $7,500 in capital. But of course, that's not what we did. To make our bearish bet against XLU, we bought put options. The specific put option I recommended at the time was selling for just $174 per contract, giving small dollar accounts a way to make this bearish play for practically nothing. And of course, for such a low cost, I know that some of my bigger traders loaded up, buying tens and even hundreds of contracts. And again on this one, we didn't need much time before we were able to lock in handsome profits. In fact, and you may have noticed this yourself, you can actually make money quicker when stocks are falling than when they're rising. Regardless, just 5 weeks later, shares of XLU had fallen from about $51 to $48. And the value of the put option contract that I recommended had grown by 80%. So I recommended my readers sell their put options, locking in a net profit of 80% in just 5 weeks. It's pretty nice, right? And I hope you can see that with options, making a bearish bet is just as easy as making a bullish play. In both cases, all we're ever doing is buying an option contract today for what we think is a low price and aiming to sell it for a higher price 1, 2, or at the most 3 months down the road. When we want to make a bullish play, we buy call options. When we want to make a bearish play, we buy put options. And that's really all there is to it. As I've said, there is nothing complicated about the way I use options. So don't let the professionals and all their insider lingo fool you into thinking options trading is too complicated for an average Joe. For many years now, I've helped thousands of novice investors learn to trade my simple options strategy. And I'm totally confident that you can do it too. Next time, I'll walk you through placing an options order with your broker. I'll see you then.